All right, accounting fans, welcome to the deep dive. We're going to be diving deep into some accounting concepts today, getting you ready for that big exam.
Absolutely. Going to be breaking down those tricky concepts so you can remember and actually use them on exam day.
This deep dive is brought to you by Grade Guru, by the way.
Yeah, they've got even more practice exams and full summaries waiting for you if you need extra help over at gradeguru.nl.
All right, let's jump right in. First up, the accounting equation. You've probably seen the basic version, right? Assets equals liabilities plus equity.
Uh-huh.
But there's more to it. There's this expanded version
Right.
that really kind of paints a fuller picture.
Yes.
So walk us through this expanded equation.
Sure. Think of it like looking under the hood of a car.
Okay.
The basic equation just shows you what the car is,
Right.
but the expanded equation shows you how it go T there.
Uh-huh.
So it factors in revenues, expenses, and dividends.
Okay, so it's not just a snapshot.
Right.
It's kind of seeing the whole journey.
Yeah, it's like it's the whole journey of the business, not just a snapshot.
Got it. Can you give us an example?
Sure. Let's say a business starts with 50,000 euros in assets
Okay.
and 20,000 euros in liabilities.
All right.
Their initial owner's equity is 30,000. Now let's say they make 10,000 in revenue.
Okay.
Spend 4,000 on expenses,
Uh-huh.
pay out 2,000 in dividends.
Right.
Using that expanded equation, their owner's equity would now be 34,000.
I see. So it's like it's a dynamic element, this equity that we're
Yeah.
tracking with that expanded equation. Okay. Now, what about closing the books at the end of an accounting period?
Right.
Is that like me kind of tidying up my desk after a long day, getting everything organized?
Yeah, it's a bit like that, yeah.
Okay.
The closing process is all about getting your accounts organized and ready for a fresh start.
Like hitting the reset button.
Exactly. It's like starting a new chapter in the company's financial story.
I like that.
Yeah.
So what are the steps involved in this closing process?
Well, there are four main steps involved.
Okay, lay them on me.
First, we close the revenue accounts,
Okay.
transferring their balances to the income summary account.
So the income summary, is that like a temporary holding place?
Precisely.
Okay.
The second is we do the same with expense accounts, transferring their balances over to the income summary.
Okay.
So that leaves our revenue and expense accounts at zero
Fresh start.
for the next period.
Got it. What's next?
Third step is transferring your balance in the income summary to retained earnings.
Okay.
So this updates the retained earnings account to reflect the company's profit or loss for the period.
Okay, and last but not least.
Finally, we close the dividends account, transferring its balance directly to retained earnings, which reduces the company's retained earnings.
Okay, so we've reset, we've updated, and we've accounted for those distributions.
Yeah.
Now, why is this closing process so crucial? Why do we even bother?
It's all about accuracy and clarity in your financial reporting.
Uh-huh.
By resetting those temporary accounts.
Right.
We ensure that each accounting period's income statement only reflects the revenues and expenses from that period.
So no mixing up stories from different chapters.
Okay.
Makes sense. Now, let's talk about something that I personally always trip up on. When do we recognize revenues and expenses?
Yeah, that's a common question.
I mean, it seems pretty straightforward,
Right.
like when cash changes hands, right?
It might seem like it's all about when the cash changes hands,
Yeah.
but it's actually about recognizing revenue when it's earned and matching expenses to the period when they helped generate that revenue.
Okay, so it's not just about the cash flow. So tell me about, elaborate on these principles.
Sure.
Give me some examples.
Okay. The revenue recognition principle, that says we recognize revenue when it's earned.
Even if you haven't received the cash yet.
Even if we haven't received the cash yet. For instance, if a company delivers a service worth 5,000 euros in December,
Okay.
but the customer pays in January, that 5,000 euro revenue belongs in December, not January.
Because that's when the service was actually provided, right?
Correct.
Okay, what about expenses then?
Expenses, that's where the matching principle comes in. This principle tells us to match expenses with the revenues they help generate. So if a company spends money on advertising to boost sales in December,
Right.
but pays the bill in January,
Okay.
we'd record the expense in December because that's when it contributed to generating revenue.
So it's about accurately reflecting the costs associated with earning the revenue. I'm starting to see how these principles are like painting a truer picture of a company's performance.
Exactly.
All right. So we've recognized our revenue. We've matched our expenses. Now, what about adjusting entries?
Right.
Are they like making those minor tweaks to the story, to the financial story before we finalize it?
Yeah, you could say that Adjusting entries are crucial
Okay.
for ensuring that our financial statements reflect the true economic reality of the business.
Uh-huh.
So they help us capture those transactions that haven't been recorded yet or haven't been fully used up.
So it's like fine-tuning the story.
Yeah.
Okay, what are the main types of adjustments we should be looking out for?
The two big ones are accruals and deferrals.
Okay. Accruals. Tell me about accruals.
Accruals, those are for transactions that have happened
Okay.
but haven't been recorded. Think of it like working a full week but not receiving your paycheck yet.
Okay, yeah.
You've earned the money, but it's not officially on the books.
So it's recognizing that revenue or that expense that's like in the works, but just hasn't been documented yet.
Exactly.
Okay. Deferrals.
Deferrals, those are for things that have been paid for or received payment for in advance, but haven't been fully used up yet. It's like prepaying for a year of insurance. You wouldn't expense the entire amount up front.
Right, because you haven't used up all the coverage.
Correct.
So accruals are about recognizing the things that have happened
Yes.
but aren't recorded. Deferrals are about spreading out the recognition of the things that have been paid for in advance. Can you give me an example of each?
Sure. Let's illustrate this with an example.
Yeah.
Imagine a company earns 2,000 euros in interest on an investment,
Okay.
but won't receive the cash until next month.
Right.
To ensure this revenue is recognized in the current period, we'd make an adjusting entry, debit interest receivable, which is an asset,
Okay.
and credit interest revenue.
So you're recognizing the revenue now,
Yes.
but creating an asset that represents the company's right to receive that cash later.
Exactly.
Okay, cool. What about a deferral example?
Let's say a company prepays 6,000 euros for 6 months of insurance.
Okay.
At the end of the first month, they've only used up 1/6 of the coverage.
Right.
To adjust for this, we debit insurance expense for 1,000 euros and credit prepaid insurance for the same amount.
So you're only expensing the portion that's actually been used up.
Okay.
Adjusting entries, crucial. Now, on to something a bit more tangible, merchandising transactions. It sounds basic, buying and selling stuff, but I bet there's more to it than that. Right.
You're right. There are some accounting nuances when it comes to merchandising.
Oh.
First, we need to distinguish between two main inventory systems,
Okay.
perpetual and periodic.
Right.
The perpetual system provides real-time updates
Okay.
to inventory records with every purchase and sale.
So that's pretty high tech.
Yeah, it's like having a live feed of what's happening in your warehouse.
What kind of businesses would typically use a system like that?
You'll often find perpetual systems in businesses with high transaction volumes
Okay.
and those that need to keep a close eye on inventory levels,
Makes sense.
like big retail stores or online marketplaces.
So every purchase increases inventory,
Yeah.
and every sale decreases inventory, and also recognizes the cost of goods sold.
Correct.
Okay.
Hmm.
What about the periodic system? Is that more for those businesses that aren't as, I don't know, concerned with the up-to-the-minute, like, inventory tracking?
Yeah, the periodic system is a bit more relaxed. It doesn't
Mhm.
track inventory continuously.
Okay.
Instead, it relies on periodic physical counts to see how much inventory is left at the end of a period.
Right.
And then they calculate cost of goods sold based on the beginning inventory purchases and ending inventory figures.
So it's like a little bit more hands-on and less frequent in its updates.
Yeah, it's simpler, but it doesn't provide that constant snapshot of what's going on with inventory.
Okay. Pros and cons to each. Got it. Now, what about discounts? Who doesn't love a good deal, right?
Discounts are a big part of the business world.
For sure.
Let's start with sales discounts, those incentives for buyers to pay their invoices early.
Okay.
To track these, sellers use a special contra account called sales discounts.
A contra account. What's that all about? Why not just reduce the sales figure directly?
Think of it like this. Using a contra account adds another layer of detail
Okay.
to your financial statements. It allows you to see both the original sales amount and the discount given, giving you a clearer picture of how discounts are affecting your overall revenue.
So it's about transparency and giving more detail.
Yeah.
Okay. Now, how about when businesses are on the receiving end of a discount?
When buyers get discounts for paying early, they use a similar contra account called purchases discounts.
Okay.
This reduces the cost of goods sold, ultimately impacting the company's net income.
Okay, so both sides have these special accounts to kind of keep track of those discounts and what they're doing to their bottom line.
Right.
Okay, starting to see the importance of these seemingly small details. Now, shifting gears to another important detail, shipping costs. We've all seen those free shipping offers online. But somebody's got to be paying for it, right?
You got it.
So in the world of accounting, how do we figure out who covers those shipping costs?
We use the terms freight in and freight out
Okay.
to distinguish between shipping costs paid by the buyer and the seller. Freight in refers to the costs buyers pay to get the goods shipped to them.
Okay.
These costs are considered part of the inventory cost
Right.
and are added to the merchandise inventory account.
So if I buy a couch online and pay, like, I don't know, 50 euros for shipping, that 50 euros just becomes part of the cost of the couch.
That's right. It's all part of getting those goods to your doorstep.
Okay, freight out.
Freight out refers to the costs sellers pay to ship goods to their customers. These costs are treated as a selling expense, not part of inventory cost,
Okay.
and are usually recorded in a freight out or delivery expense account.
So freight in increases inventory costs for the buyer. Freight out increases selling expenses for the seller. Simple enough, right? But how do we know who's responsible for those costs in the first place?
That's where those FOB terms come in. FOB shipping point and FOB destination.
Oh, FOB terms. Those can be a little tricky. Can you walk us through the differences there?
Absolutely. FOB shipping point means ownership of the goods transfers from the seller to the buyer as soon as the goods leave the seller's shipping dock. So the buyer pays for shipping, freight in, and assumes the risk of loss or damage during transit.
So as soon as it's out of the seller's hands, it's the buyer's problem.
Exactly.
Okay. FOB destination.
FOB destination means ownership transfers when the goods arrive at the buyer's location. So the seller pays for shipping, freight out, and bears the risk of loss or damage during transit.
It's like a little game of hot potato. Okay.
Mm.
Why are these FOB terms so important in accounting? Why do we care?
Because they dictate who records the shipping costs
Okay.
and when.
Okay.
It affects inventory valuation, expense recognition, and even revenue recognition in some cases.
Okay.
Understanding these seemingly small details can make a big difference in accurately representing a company's financial position.
This is fascinating. These details matter.
Right.
All right. Back to our inventory systems showdown, perpetual versus periodic, right? Let's recap the key differences between those two.
You got it. The perpetual system updates inventory continuously with each transaction, giving you a real-time view of inventory levels and cost of goods sold. This makes it a good fit for businesses with high transaction volumes or complex inventory management needs.
It's like having that super organized, always up-to-date spreadsheet.
Exactly.
What about periodic?
On the other hand, the periodic system updates inventory at specific intervals,
Okay.
usually through physical counts.
Right.
It's simpler and less costly to implement,
Okay.
making it a suitable choice for smaller businesses or those with less complex inventory.
So it's more like taking stock every now and then rather than that constant stream of updates.
Okay, so regardless of the system used, though, we still have that one goal, right?
Right.
To accurately calculate that cost of goods sold.
Correct.
Remember that formula: beginning inventory plus purchases minus ending inventory.
You got it.
All right, now how does the choice of the inventory system affect how we actually arrive at that cost of goods sold number?
With the perpetual system, cost of goods sold is calculated with each sale.
Okay.
With the periodic system, it's calculated at the end of the period,
Right.
after a physical inventory count,
Okay.
to figure out that ending inventory value. So there could be differences in timing and potentially even the final numbers. Right.
Correct.
Okay, this is making a lot more sense now.
Okay.
I'm ready to face those inventory costing methods. FIFO, LIFO, weighted average cost. Bring it on.
It can be a bit confusing, but don't worry, we'll break it down.
Right.
Each method has its own way of determining cost of goods sold and ending inventory value. And the method a company chooses can impact their financial statements, especially when prices are fluctuating.
All right, I'm all ears. Let's start with FIFO.
FIFO stands for first in, first out. It assumes that the oldest inventory items are sold first.
Okay.
So to calculate cost of goods sold, we use the cost of the oldest inventory first. The remaining inventory is valued based on the cost of the most recent purchases.
It's like organizing your pantry, using up the oldest items first to prevent anything from going bad.
Yeah, that's a great way to think about it.
Okay. So FIFO often aligns with the actual physical flow of goods, especially for perishable items, right?
Correct. Plus, it results in ending inventory that reflects more recent costs, which is generally a more accurate picture of the current market value.
Makes sense. But is there a downside to FIFO, especially when prices are increasing? Like, if we're in an inflationary environment, does FIFO have a downside?
You're right. During periods of inflation, FIFO can lead to lower cost of goods sold
Okay.
because you're using the cost of older, cheaper inventory.
Right.
This can result in higher profits on paper, which may seem good,
Okay.
but can also lead to higher taxes.
So higher profits, bigger tax bill.
Yeah.
All right. LIFO.
LIFO, or last in, first out, takes the opposite approach.
Okay.
It assumes that the newest inventory is sold first. So we use the cost of the most recent purchases to calculate the cost of goods sold.
So it's like always stocking from the front
Exactly.
and just using the newest items first,
Right.
regardless of when the older items came in.
Right. One advantage of LIFO is that it can better match current costs with current revenues on the income statement. During times of inflation, this is because you're expensing the newest and usually most expensive inventory first,
Okay.
leading to higher cost of goods sold,
Right.
lower reported profits, and potentially lower taxes.
So it's a good tax strategy during those inflationary periods, but I imagine it doesn't always line up with the actual flow of inventory, right?
You're right. LIFO is less common in situations where the physical flow of inventory is important,
Okay.
like with those perishable goods we talked about.
Right.
It's more common in industries where inventory costs tend to rise consistently.
All right. So FIFO, better for the flow. LIFO might help us manage taxes when prices are going up. Now, weighted average cost. What's special about that?
The weighted average cost method that
Yeah.
uses an average cost for
Okay.
all inventory items, calculated by dividing the total cost of goods available for sale by the total number of units available. It's useful when dealing with large quantities of similar item,
Okay.
where tracking each item individually would be impractical.
So it's like blending all those different costs together.
Exactly.
Okay. How does weighted average cost handle those price changes?
It offers a middle ground approach during inflation.
Right.
Since it uses an average cost that includes both older and newer purchases,
Right.
cost of goods sold and ending inventory will usually fall somewhere between the figures you'd get with FIFO and LIFO.
So it's like a compromise.
Yeah.
Not as sensitive to inflation as FIFO, but not as aggressive as LIFO when it comes to managing that cost of goods sold and those taxes.
Exactly. Now remember, the choice of inventory method can have a big impact
Right.
on a company's financial statements and tax liability.
Yeah.
They need to consider things like the nature of their inventory, their industry, and the economic climate when choosing the best method.
Okay. This is all making so much sense now. I feel like I'm really starting to understand how these inventory decisions a company makes can affect its overall health. Now, can we look at a real-world example to see how all of this plays out?
Great idea. Let's take a look at a company called Top Vision that sells drones.
Right.
Let's say in April 2022, they have the following transactions. They start the month with 40 drones in stock,
Right.
each costing 1,000 euros. On April 5th, they purchase 20 more drones at 1,100 euros each.
Right.
On April 11th, they sell 40 drones, but the buyer gets a purchase discount of 660 euros.
Okay.
Let's see how we'd calculate cost of goods sold and ending inventory for Top Vision using the perpetual inventory system.
Okay, so we have a beginning inventory, we've got a purchase, and we've got a sale, all within the same month.
Right.
How do we approach this?
First, let's calculate cost of goods sold.
Okay.
Since we're using the perpetual system, we do this at the time of each sale. Top Vision sold 40 drones at 1,000 euros each,
Right.
totaling 40,000. But we need to subtract that 660 euro purchase discount
Right.
they offered to the buyer.
Okay.
So the final cost of goods sold for this sale is 39,340.
So even though the buyer got a discount, we're still accounting for the full cost of those 40 drones in our inventory records.
Exactly.
Okay. Ending inventory. How do we calculate that?
We need to consider how many drones are left and their costs.
Okay.
Top Vision started with 40 drones,
Right.
bought 20 more, giving them 60 total.
Uh-huh.
They sold 40, so they have 20 left.
Okay. And how do we figure out the value of those remaining 20 drones?
Under the perpetual system, inventory is always updating.
Okay.
So we know 40 of those drones were originally bought at 1,000 euros each,
Okay.
and the remaining 20 were purchased at 1,100 each.
Okay, so we got to consider those different purchase prices.
Exactly. So to calculate ending inventory, we multiply the quantity of each batch of drones by their respective costs
Okay.
and add those amounts together.
Right.
So 40 drones at 1,000 euros each is 40,000 euros, plus 20 drones at 1,100 each is 22,000 euros. Adding those together gives us a total ending inventory of 62,000.
Wow, that really brought it all together. Inventory systems, costing methods, discounts, all working together in a real-world scenario. That's really cool to see. Now, before we move on to some other key concepts,
Sure.
let's take a moment to talk about something really important. Ethics.
Okay.
Ethics in accounting,
Think about it. We've talked about different inventory costing methods
right?
and how each one can affect a company's reported profits and taxes,
Especially during inflation.
especially during times of inflation.
So there's potential there for companies to maybe manipulate those numbers to their advantage.
There's always that risk.
Okay.
Ethical accounting practices emphasize transparency,
Uh-huh.
accuracy, and fairness.
Okay.
Companies have a responsibility to choose accounting methods that truly represent their financial position, even if it means paying higher taxes.
So it's about doing the right thing, even when it's not necessarily the most financially advantageous thing.
Exactly. Transparency and integrity are essential in accounting. Stakeholders like investors, creditors, and even the public rely on accurate financial information
Right.
to make informed decisions. Playing games with those numbers can erode trust and damage a company's reputation.
Yeah, we've all heard those stories about companies cooking the books to make themselves look more profitable than they are.
Right.
It might work in the short term, but it's not a sustainable strategy.
Exactly. Ethical accounting is about more than just following the rules.
Yeah.
It's about upholding ethical principles
Right.
and maintaining trust in the financial system. Now, let's move on to another important distinction: the difference between perpetual and periodic inventory systems. We touched on this earlier, but it's worth exploring in more detail because it can affect a company's efficiency and decision-making.
Sounds good to me. Let's dive back into that world of inventory systems.
Remember, the perpetual inventory system updates inventory continuously with every purchase and sale. It's like having that live stream of your inventory level, so you always know exactly what's on hand, what's been sold, and what needs to be reordered. It's more complex and can be more expensive to implement,
Right.
but it offers high accuracy
Okay.
and can be a lifesaver for businesses with a lot of transactions or complex inventory needs.
So it's like that super efficient inventory control system.
Yeah.
It's just always on top of things. All right, now the periodic system, how's that different?
The periodic system only updates inventory records at specific intervals, like at the end of the month or the quarter.
Okay.
Instead of tracking each individual transaction,
Right.
they do a physical count to determine ending inventory levels.
Okay.
Then they use the beginning inventory, purchases, and that ending inventory figure to calculate the cost of goods sold.
Okay. So it's more of a manual process, doesn't require that constant tracking. That sounds simpler, but I imagine there are some drawbacks to that as well, right?
You're right. It is simpler and less costly than the perpetual system,
Right.
but you don't have that real-time insight
Right.
into inventory levels.
Okay.
That can be a challenge for businesses with fluctuating demand or those dealing with perishable goods.
So it's a trade-off. It's a trade-off between simplicity and real-time accuracy.
Exactly.
So what are the factors businesses should consider when they're making that decision? Which system is right for them?
Well, it depends on the nature of their business.
Okay.
Large retailers or e-commerce companies
Right.
with tons of transactions and diverse products often benefit from the detailed insights of a perpetual system.
Makes sense.
On the other hand, smaller businesses with limited resources or simpler inventory might find the periodic system more practical.
Okay. So there's no one-size-fits-all.
No.
It's about what your needs are and your resources.
Okay, got it. Now let's dive back into that world of inventory costing methods.
We talked about FIFO, LIFO, and weighted average cost, but let's just revisit them, look at them with a fresh perspective, just to remind ourselves how each of those methods impact how we value inventory. Calculate that cost of goods sold.
You got it.
All right, FIFO.
FIFO, remember, it stands for first in, first out, meaning we assume the oldest inventory is sold first. This method often reflects the actual flow of goods, especially for items that have a shelf life or could become obsolete.
So yeah, we're using the cost of those older items to calculate cost of goods sold, and then what's left over, the remaining inventory, is valued based on those more recent purchases.
Right.
Okay, so one advantage to FIFO is that it often aligns with the physical flow of goods, especially for those perishable or time-sensitive items. And plus, the ending inventory reflects those more recent costs, giving you a clear picture of its current market value.
Correct.
Okay, but what happens when prices are going up? Does FIFO have a downside in that scenario?
You're sharp.
Okay.
During inflation, FIFO can result in lower cost of goods sold, which can lead to higher reported profits,
Right.
but also potentially higher taxes.
Right, so higher profits might come with that bigger tax bill. All right, LIFO. Remind me about LIFO.
LIFO, or last in, first out, works in reverse. We assume the newest inventory is sold first. So we use those costs to calculate the cost of goods sold.
So it's like always using the freshest ingredients in your pantry, right?
Exactly. LIFO can be beneficial during periods of inflation because it matches current costs with current revenues,
Right.
resulting in a higher cost of goods sold,
Hmm.
potentially lower taxes,
Right.
but maybe not the most accurate reflection of inventory flow.
Right. 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 So it's a good strategy for managing taxes when prices are rising, but maybe not ideal for every situation.
Duh.
Okay. Weighted average cost. Remind me about weighted average cost.
It's all about finding a balance. We calculate a weighted average cost for all inventory items by dividing the total cost by the total number of units. It's a good approach when dealing with homogeneous or interchangeable items. Where tracking individual costs is impractical.
So yeah, like creating a single average cost that reflects all those different purchase prices.
Exactly. And it's a more middle-of-the-road approach when it comes to inflation. Cost of goods sold and ending inventory will usually fall somewhere between the figures you'd get with FIFO and LIFO.
So a nice compromise between those two extremes.
Oh.
I'm seeing how choosing the right inventory method can really affect that company's, its financial picture.
Absolutely.
So what are the main things companies should consider when they're making that choice?
Remember, the best method depends on the company's specific circumstances.
Okay.
They need to carefully consider their inventory, their industry, and the economic environment when making this choice. Host. They need to carefully consider their inventory, their industry, and the economic environment when making this choice. Now, let's switch gears and talk about sales and purchase discounts.
Okay, discounts. What's the accounting angle on these?
Discounts can significantly impact a company's financial performance. Let's start with sales discounts. Those incentives sellers offer buyers to pay invoices quickly.
Oh.
These discounts are recorded using a special account called sales discounts, which is a contra revenue account.
Contra revenue account.
Yeah.
Why not just reduce the sales figure directly?
Think of it like this. Using a contra revenue account provides a more detailed picture of your financial performance.
Yeah.
It allows you to track both the total amount of sales and the amount of discounts given, giving you a better understanding of how discounts affect your overall revenue.
So it's about transparency and providing a clearer picture. Now, what about when businesses are on the receiving end of a discount? How do they handle that?
Buyers use a similar contra account called purchases discounts to track discounts received for paying suppliers early.
Okay.
This reduces their cost of goods sold, ultimately impacting your net income. It's all about accurately reflecting the actual cost of their purchases.
So it's like two sides of the same coin. Both buyers and sellers use these special accounts to track discounts and what they're doing to their financials.
Exactly. Now, let's talk about transportation costs, another area that often causes confusion in accounting.
Okay. Transportation costs. Somebody's always got to pay to get those goods from one place to another. So how does accounting deal with those costs?
It depends on who's responsible for the shipping.
Okay.
We use two key terms, freight in and freight out. Freight in represents the shipping costs buyers pay to get their goods delivered.
Okay.
We treat those costs as part of the inventory cost and add them to the merchandise inventory account.
So if I order a new laptop online and pay under 20 euros for shipping,
All right.
that 20 euros just gets added to the cost of the laptop on the books.
Exactly. Freight out, on the other hand, refers to the shipping costs sellers pay to get goods to their buyers. These costs are treated as selling expenses and are not part of the inventory cost. They're typically recorded in a freight out or delivery expense account.
Okay. So freight in increases the cost of inventory for the buyer. Freight out increases the selling expenses for the seller. Pretty straightforward. But how do we know who's responsible for those costs in the first place?
Those trusty FOB terms come into play again. FOB shipping point and FOB destination.
FOB terms. I swear, those are like a secret code in the business world. Can you remind us what they mean?
FOB shipping point means ownership of the goods shifts from the seller to the buyer as soon as the goods leave the seller's shipping dock. In this case, the buyer pays for shipping, freight in, and takes on the risk of loss or damage during transit.
So once the goods are out the door, they're the buyer's responsibility.
Exactly. FOB destination means ownership transfers when the goods arrive at the buyer's location. In this case, the seller pays for shipping, freight out, and carries the risk.
Oh, it's like a game of hot potato. Okay, so why are these FOB terms so important in accounting? Why do we care?
They determine who's responsible for the shipping costs, which affects how and when those costs are recorded in the books. It can impact inventory valuation, expense recognition, and even revenue recognition in some cases.
Okay, this is making me realize how important it is to pay attention to all these details. They can really make a difference in a company's financial picture. Now, can we revisit the closing process? I just want to make sure I understand how it all works.
Absolutely. The closing process is all about wrapping up an accounting period and getting your books ready for a fresh start in the next period.
Okay.
We're basically transferring balances from temporary accounts like revenues, expenses, and dividends to permanent accounts like retained earnings.
It's like hitting the reset button on those temporary accounts, right? So you can
Right.
start fresh in the new period.
You got it. And there are four main steps involved. First, we close the revenue accounts. We do this by transferring their balances to the income summary account. Think of it like gathering all those revenues into a temporary holding place. Next, we do the same with the expense accounts, transferring their balances to the income summary account as well.
Okay.
The third step is to close the income summary account to retained earnings. This step updates the retained earnings account to reflect the company's profit or loss for the period.
Okay.
Finally, we close the dividends account to retained earnings. This step reflects the distribution of profits to shareholders, reducing the company's retained earnings.
Wow, there are a lot of moving parts in that closing process, but why is it so important to go through all those steps?
It's crucial for ensuring that our financial statements accurately reflect the company's performance for each accounting period. By zeroing out those temporary accounts, we ensure that each period's income statement shows only the revenues and expenses for that specific period.
Yeah, it's like making sure each chapter of the financial story is telling the right part of the tale. Okay, got it. Now, let's talk about adjusting entries again. I just want to make sure I have a solid grasp on those.
Adjusting entries are all about ensuring that your financial statements tell the most accurate story possible.
Okay.
We use them to capture those transactions that haven't been recorded yet or haven't been fully used up.
Yeah. It's like making those little tweaks to the story to make sure every detail is accurate.
Exactly. We have two main types, accruals and deferrals. Remember, accruals are for transactions that have already happened but haven't been recorded. It's like working a full week, but not getting paid until the next week. You've earned the money, but it's not officially on the books yet.
Right, right. So it's about recognizing those in the works revenues or expenses that haven't been documented yet.
Exactly. Now, deferrals are for situations where we've paid for something in advance or received payment in advance, but we haven't fully used it up or earned it yet. Think of it like prepaying for a year of insurance. You wouldn't expense the entire amount up front because you haven't used up all the coverage.
Right. So accruals are about recognizing things that have happened but aren't recorded, and deferrals are about spreading out the recognition of things that have been paid for in advance.
Precisely. Let's look at an example of each. For an accrual, imagine a company earns 2,000 euros in interest on an investment, but they won't receive the cash until next month.
Okay.
To make sure this revenue is recognized in the current period, we make an adjusting entry. Debit interest receivable, an asset, and credit interest revenue.
So we're recognizing the revenue now, but creating an asset that represents the company's right to receive that cash later.
Exactly. Now, for a deferral example, let's say a company prepays 6,000 euros for 6 months of insurance. At the end of the first month, they've only used up 1/6 of that coverage. So we debit insurance expense for 1,000 euros and credit prepaid insurance for the same amount.
So we're only expensing the portion of the insurance that's been used up.
Correct. Now, bank reconciliations, I think that's something a lot of people might not immediately think about when it comes to accounting, but it's a super important internal control to make sure everything is accurate and above board.
Okay. Bank reconciliations. I have to admit, that one always kind of makes me nervous. What exactly are we doing there?
It's all about making sure our cash records match up with what the bank says we have. It's a crucial internal control to prevent errors and potential fraud.
Okay, so we're comparing our records to the bank's records. What are some reasons why those records might be different?
There are several reasons. Sometimes there are deposits in transit money we've deposited that hasn't been processed by the bank yet.
What?
Or we might have outstanding checks we've written that haven't been cashed yet.
So it's about timing differences.
Exactly. And there's always the chance of errors on either side. Banks can make mistakes, and we can too. That's why regular bank reconciliations are so important. They help catch those discrepancies early on.
So it's like a little detective game where we're trying to find the reasons for any differences between our records and the bank statement.
That's a great analogy. To do a bank reconciliation, we create a statement that compares our ending cash balance to the bank statement balance. Then we look for any items that explain the differences.
Like what kind of things would we look for?
Deposits in transit, outstanding checks, and any bank errors or company errors. For instance, we might have recorded a deposit for the wrong amount or forgotten to record a check. We'd make adjustments to either our records or the bank side of the reconciliation to correct any errors.
So we're basically making sure everything lines up perfectly.
Precisely. It's a detective game where we're trying to bring those two balances into harmony.
Okay, this is making me realize how important accuracy is in accounting. Every detail matters. Now, switching gears a bit, let's talk about petty cash. It might seem like a small detail compared to these big concepts we've been discussing, but it plays an important role in internal control.
Right.
Petty cash. I always think of that as the little cash stash for emergencies or small expenses. What's the accounting perspective on this?
Think of petty cash as a mini accounting system
Okay.
within the larger system. It's about having a small amount of cash on hand to cover minor expenses without having to write checks for every little thing.
Yeah, so like a little slush fund for those day-to-day expenses, that would be a hassle to track individually.
Yeah.
How does it work from an accounting standpoint?
First, you establish a petty cash fund by cashing a check for a specific amount, let's say 100 euros.
Yeah.
You keep this cash in a secure place and use it for those small expenses like office supplies or postage. Each time you use money from the petty cash fund, you fill out a petty cash voucher that documents the date, amount, purpose, and who received the cash.
So it's like a mini paper trail for every penny that leaves the fund.
You got it. You keep these vouchers in the petty cash box along with the remaining cash. The total of the vouchers plus the remaining cash should always equal the original amount of the fund. When the cash gets low, you replenish the fund by totaling the vouchers and cashing a check for that amount.
So you're basically reimbursing the petty cash fund for the expenses that were paid out of it. I see how this system helps keep track of those small expenses and prevents anyone from, misusing the funds.
Exactly. Now, when you replenish the petty cash fund, you'll make journal entries to record those expenses. You debit the appropriate expense accounts based on what's documented on those vouchers, and credit cash for the total amount you use to replenish the fund.
Okay, so even though petty cash might seem like a small thing, it's still important to track it properly.
Absolutely. Now let's step back and consider the big picture for a moment. What role does accounting play in the overall success of a business?
Ooh, that's a great question. I imagine accurate accounting is pretty essential for any business to thrive.
You're absolutely right. Accounting is often called the language of business for a reason.
Right.
It gives businesses the financial information they need to make informed decisions,
Yeah.
from tracking sales and expenses to analyzing their overall financial health.
So, though it's not just about crunching numbers, it's about understanding what those numbers mean and using them to guide the business's strategy.
Precisely. Without good accounting practices, businesses would be making decisions in the dark.
Right.
Good accounting helps them understand where they stand financially, identify areas where they can improve, and plan for the future.
So it's like having a financial GPS to navigate the business world.
That's a great way to put it. Accounting is the backbone of any successful business. And remember, if you're studying for your accounting exams, Grade Guru has amazing resources to help you master these concepts.
Right. Students can find practice exams and full summaries at gradeguru.nl. Don't wait until the last minute to check it out. Now let's dive into another important concept, revenue recognition. Sounds pretty straightforward, right? We make a sale, we recognize the revenue, done. But I have a feeling there's more to it than that.
You're absolutely right. Revenue recognition is about determining when it's appropriate to record revenue in the financial statements. It can be tricky, especially in today's complex business world with long-term contracts, bundled services, and varying payment terms.
Okay, I'm ready to unravel this revenue recognition mystery. What are the main guidelines we should be following?
The guiding principle is that revenue should be recognized when it's earned, not necessarily when the cash is received. This aligns with the accrual basis of accounting, which is all about matching revenues with expenses in the period they're earned or incurred.
So even if a customer hasn't paid yet, as long as the company has fulfilled its obligations under the contract, we can recognize the revenue.
Exactly. It's about recognizing revenue when the company has substantially completed its performance obligations. To help with this, we have a widely accepted accounting standard known as ASC 606 or IFRS 15, depending on which framework the company follows.
Okay, so there are specific standards to help companies navigate this complex world of revenue recognition. What are the main steps involved in applying these standards?
There are 5 key steps.
Okay, lay 'em on me.
1. Identify the contract with a customer. This involves determining if there's a valid contract, understanding the terms, and making sure both parties are committed to fulfilling their obligations.
Okay.
2. Identify the performance obligations in the contract. Here, we break down the contract into the specific goods or services the company must deliver.
Got it.
3. Determine the transaction price. This is about figuring out how much consideration the company expects to receive for fulfilling its obligations. We factor in things like variable consideration, discounts, and payment terms.
Right.
4. Allocate the transaction price to the performance obligations. Once we know the price, we divide it among the different obligations based on their standalone selling prices.
Yeah.
And 5. Recognize revenue when or as the entity satisfies a performance obligation. Finally, we recognize revenue as the company fulfills each obligation, either at a specific point in time or over time.
Wow, that's a very detailed process.
Hmm.
I can see how this helps companies recognize revenue accurately, even in those more complex situations. Can we look at some real-world examples to see how this plays out?
Absolutely. Imagine a software company selling a subscription-based software package.
Oh.
They sign a contract with a customer for a 1-year subscription for 12,000 euros, payable in monthly installments of 1,000 euros.
Okay, so we've got our contract, we've got our transaction price.
Hmm.
How would they apply those 5 revenue recognition steps?
They've already identified the contract. Next, they identify the performance obligation, which is providing access to the software and any updates or support for a year.
So their obligation is to provide that ongoing value throughout that subscription period.
Exactly. The transaction price is 12,000 euros. And since there's only one performance obligation, there's no need to allocate the price further. The final step is figuring out when to recognize the revenue.
Since it's a subscription, I'm guessing they wouldn't recognize the entire 12,000 all at once, right?
You're right. They recognize it over time as they provide access to the software each month. They would likely recognize 1,000 euros in revenue each month as the customer receives the benefits of that subscription.
Okay, that makes perfect sense.
Yeah.
They're recognizing the revenue as they deliver the service. Can we look at a different scenario? How about a construction company building a bridge for a government agency?
Sure.
Let's say the contract is for, I don't know, 10 million euros and will take 2 years to complete.
Great example. First, they identify the contract. Then their performance obligation, which is constructing the bridge according to the agreed-upon standards.
So they're obligated to deliver a completed functional bridge at the end of those 2 years.
Exactly. Now, the key question is, would they recognize revenue at a point in time or over time?
Well, since this is a large-scale project with a pretty long duration, I'm going to guess over time.
You're on the right track. In this case, the government agency is benefiting from the construction as it progresses.
Right.
So revenue recognition over time makes sense.
So as they make progress on the bridge, they would recognize a portion of that revenue based on how much they've completed.
Exactly. They would need a reliable way to measure progress, like tracking costs, labor hours, or milestones reached. This allows them to recognize revenue gradually as the project moves forward.
These examples are really helping me understand how revenue recognition works in different situations.
Glad to hear it. It's all about accurately reflecting the timing and amount of revenue a company earns, even in complex scenarios. Now, before we wrap up this part of our deep dive, let's take a moment to consider a broader question. How might technology like artificial intelligence and blockchain shape the future of accounting?
Ooh, that's a fascinating question. I can only imagine that technology is going to continue to have a big impact on how accounting is done.
You're right. These advancements have the potential to automate tasks, improve accuracy, and even transform how we think about financial reporting. It's an exciting time to be in the accounting world. We'll dive into more essential concepts in the next part of our deep dive. Stay tuned.
Welcome back to the Deep Dive. We've been exploring some pretty complex accounting concepts, but I'm feeling more confident with each topic we cover.
That's great to hear. Remember, practice makes perfect. The more you apply these concepts, the better you'll understand them.
You're right. Now, where do we leave off? Ah, yes, the potential impact of technology on the future of accounting. It's a topic that's both exciting and a little bit, well, daunting.
It definitely is. Technology is already transforming the accounting profession, and that trend will only accelerate in the years to come.
So what kind of impact are we talking about here? Will robots be replacing accountants anytime soon?
Well, While robots taking over completely might be a bit of a science fiction scenario, technology is changing the skills accountants need to thrive. Artificial intelligence, for instance, can automate those repetitive tasks like data entry, freeing up accountants to focus on more analytical and strategic work.
So it's less about replacing accountants and more about empowering them to work smarter and focus on those higher level tasks.
Exactly. Accountants will need to be comfortable working with technology and interpreting the insights it provides. It's no longer enough to just crunch numbers.
Right.
They need to be able to tell the story behind those numbers and provide strategic guidance to businesses.
So accountants are becoming more like data analysts and business advisors.
You could say that. They need a solid understanding of technology, data analytics, and business strategy to succeed in this evolving landscape.
That's fascinating. What about blockchain technology? I heard that it has the potential to, well, to revolutionize accounting.
Blockchain is definitely a game changer. Its ability to create secure and transparent records of transactions could streamline auditing, improve financial reporting, and reduce the risk of fraud.
So instead of relying on paper trails and manual reconciliation, we could have a system where transactions are recorded and verified in real time on a secure, shared ledger.
Exactly. It has the potential to transform how we think about financial record keeping. It's still early days for blockchain and accounting, but it's definitely a technology worth watching closely.
It sounds like the accounting profession is on the verge of some major transformations.
It certainly is. It's an exciting time to be an accountant or a student preparing to enter the field.
Well, I'm feeling inspired to dive even deeper into the world of accounting. And speaking of diving deeper, don't forget that Grade Guru has a ton of resources to help you master these concepts and ace your exams.
That's right. Head over to gradeguru.nl to access practice exams, full summaries, and personalized tutoring.
All right, accounting enthusiasts, that wraps up our deep dive for today. We've covered a lot of ground. From the expanded accounting equation to the closing process, revenue and expense recognition, adjusting entries, inventory systems and costing methods, sales and purchase discounts, transportation costs, bank reconciliations, petty cash, and even the future of accounting with technology.
Phew. It's been a whirlwind tour of the accounting world.
I feel like I've gained a solid foundation in these essential concepts. I'm ready to tackle those exams with confidence.
That's the spirit. Remember, practice makes perfect. Keep studying, ask questions, and don't be afraid to seek out additional resources like Grade Guru. You've got this.
Thanks for joining us on this accounting adventure. Until next time, happy accounting.